Real quick, before we get into the show, I wanted to share a new service called Getita that Ken and I have been using that has made us over $10,000 in Amazon reimbursements. The service requires no monthly subscription, and Getita collects a small percentage of the money they recover for you. It takes less than 5 minutes to set up and works on all Amazon marketplaces. Go to Getita.com, Getida, and enter promo code FTM400. That's FTM for Firing the Man 400 to get your first $400 in reimbursements commission free. How much money does Amazon owe you? Welcome, everyone, to the Firing the Man podcast. On today's episode, we welcome back to the show Emmett Kilduff, the co-founder and CEO of the Fortia Group, the leading investment bank focused exclusively on lower middle market e-commerce sector. With a team of seasoned professionals, the Fortia Group excels in identifying and securing the best deals for e-commerce entrepreneurs. Join us as we delve into valuations of e-commerce brands and how to best plan for exit. Welcome back to the show, Emmett.
Great to be back, David. Lots happened in 2 years.
I know, and really looking forward to getting into it. So for those of our listeners that did not tune into episode 118, which was back in January 2022, can you please share a little bit about your background and your path to co-founding the Fortia Group?
Sure. So way back in 1999, I did a master's in e-commerce. So I've always had an interest in e-commerce for the last 25 years. At the time, it was more of the dot-com boom than necessarily the e-com boom. So I went and joined the world of investment banking, initially with the firm called Credit Suisse First Boston, and then more latterly with a firm called Morgan Stanley, one of the leading US M&A firms in the world. That's where I learned the art of corporate finance, investment banking. I left there 12 years ago and started up a number of businesses. I'm sort of a serial entrepreneur. And 3 years ago, actually it was 4 years ago, I spoke to a guy called Carlos Cashman, who some of your listeners will remember. He was the founder of Thrasio, which was the start of the whole aggregator craze. And speaking to Carlos, I recognized there was a big opportunity to bring a Wall Street level of service to small and medium-sized e-commerce businesses. And that was the gap I saw 4 years ago. And so decided to set up the Fortia Group with two co-founders. And here we are. It's been a difficult last 1 to 2 years. We had a great start when the frenzy and COVID frenzy was there and M&A was relatively easy. But it's been a relatively difficult 2 years. But, you know, these things come and go.
Absolutely. Absolutely. So you mentioned quite a few changes have happened. As we sit here recording the episode in almost July 2024, what is the state of the M&A market for e-commerce companies?
Well, the M&A market for all sectors has reduced significantly since we last spoke over the last 2 years, since the market correction. Unfortunately for e-com, it's probably at the worst end of the spectrum. Yeah, you know, AI and industrials in some sectors, there's a lot going on. But e-commerce is it's pretty tough at the moment in terms of volumes, M&A volumes. Valuations have sort of stayed stable, I would have said. They've reduced. We spoke in January 2022. I would say December 2021 was the peak of e-com valuations, whether that was an FBA-led brand or a DTC Shopify or BigCommerce-led brand. And valuations have definitely come down and are very unlikely to get back to those highs. But the light is at the end of the tunnel. That these things come in cycles. Interest rates, you know, we thought 6 months ago might be down already. With the Fed, should reduce rates in the next few months, and then we'll start to see volumes tick up and valuations slowly regain their territory. There's a great chart by Goldman Sachs which shows that M&A volumes have never declined for 3 years in a row. So, you know, barring something very strange in the next sort of 6 months, the year should finish, you know, above. We've had the 2 bad years, obviously, so we shouldn't get a third year of down volumes.
Okay. Warren Buffett has this quote that I really like, and I pulled it up here. It says, when investing, be fearful when others are greedy and be greedy when others are fearful, which I really like that. And so in this current environment, where do you see opportunities?
Yeah, it's a great quote. Is the people that make the real money, you know, swim against the tide or go against the crowd. I think the real way to make money in this market is through acquisitions. Now, most of your listeners will think, I mean that someone has to acquire their business. But I actually try to encourage entrepreneurs to think about them being the acquirer. Why don't more companies take the time now to acquire one of their competitors? Or if they're strong in North America, think about an acquisition in EMEA. Or if they're strong in category A, think about an adjacent deal in category B. So it is a great time to be a buyer. There's no two ways about it. But that doesn't mean you, the entrepreneur, can't be the acquirer. And the best exits, and we'll talk about exits, ultimately are bigger and have a bit more clout and can pitch their exit to multiple types of institutional investors, not just aggregators. I mean, private equity, family offices, corporates. And so I would be trying to think about this period to scale as an entrepreneur, scale your business. And some people might be saying, well, it's hard to get acquisition finance. You don't always have to use acquisition finance. There could be clever ways to do a cashless merger by offering the founder of the other business stock in new co at an appropriate relative, number. So there's ways to be creative. I would create value through acquisition. Yeah.
Okay, very good. So let's get into valuation. I think this is something that a lot of people, when they get into business for themselves, don't often think about. And so let's start with, what are some key factors to consider when valuing an e-commerce brand?
The first for us is always the quantum of revenue. I touched on it there, but if you want to sell to aggregators, you can be 5-10 million revenue. If you want to sell to private equity, you need to be tens of millions, and strategics at least tens of millions. Private equity is a slight nuance. They do two types of deals: platform deals and bolt-ons. Platform is when they might say enter the pet category for the first time, and that is a sizable platform deal of generally at least tens of millions of dollars. But on top, when they do that deal, then they might look for add-ons or bolt-ons or tack-ons of pet businesses that could be 5 million, 7 million, 10 million revenue. But below 5 million now is really more for individual buyers, not institutional buyers. It's not an area we look to work in. And it's interesting, we've touched on aggregators. Like 3 years ago, aggregators were buying businesses of that size, but they've increased their minimum threshold. And we sort of followed suit because the energy it takes to acquire a business doing 5 million or 10 million revenue is the same, sometimes less than a business doing 1 million revenue, because they might be more organized or more proven. So yeah, quantum, the size of revenue is the first factor. Then you've got to have growing revenue. Really, really tough to sell a business where revenue is not growing. And I appreciate that's tough in this environment. But, there's it's a buyer's market. So we don't deal with distressed exits. We just deal with brands that are sort of growing well. So quantum of revenue, growing revenue. Next is net margins. And I'm less interested in gross margins. The entrepreneurs love quoting gross margins. I want the bottom line. I want, what's the bottom line after all the costs? That's much more important to me as an investment banker trying to help an entrepreneur sell. For an FBA-led brand, typically that net margin is 15 to 20% is what acquirers want to see. Sometimes for D2C, it can be slightly lower. So they're some of the big factors. The other would be, is there a moat? Is there patents? Is it protectable, or is it going to compete with a Chinese copycat that's going to, eat into the margins over time? So there's some of the key factors.
Okay, very nice. So for somebody owning and operating a business that plans on selling, what are some things that they can do now as an operator to help them out on exit day when they go to market?
In a nutshell, preparation. So I get really frustrated because if you're an S&P 500 company, if you're Elon Musk and you're thinking about selling your business, you start at least 1 to 2 years out in terms of prep. A lot of e-com entrepreneurs start 1 to 2 months out, and it's not helping themselves at all. There's so much work that can be done to get a business ready for sale before you start a formal process that can have a massive impact on valuation. So what's an example? There was a deal where an acquirer did an audit of the manufacturer in China, sent someone to do literally an audit of the manufacturing facility, and the facility scored 3 out of 10, and it killed the whole deal. There was, it just didn't tick all the boxes from a fire and safety perspective and other things. So the acquirer said, we're just not going to do the deal. At the investment committee meeting of the acquirer, it was just big X. So all that work has been put into selling that business. And then, it takes 2 to 3 quarters to change supplier and see all the products flow through for the acquirer then to maybe revisit the deal. So it's sort of dead. That's just one example. Other examples can be, well, I'll give you some of my favorite quotes in M&A, right? So flirt, date, marry is something we believe in, right? The best marriages or partnerships don't happen in a day or a month. It takes time. And it's the same with M&A. So we like to engage clients early, even 1 to 2 years out, where we work with the client, start flirting with potential buyers, start dating with them, and marry in 2 years' time. And there's 2 key benefits of that process. One, another great quote is, the best laid plans only survive contact with the enemy until you meet the enemy, right? No matter how much planning you or I or a great entrepreneur does, it's about the buyer's feedback and what they want, because they're the guys with the check, right? The cash. So during the flirt, date, marry period, we believe it's critical to put your business in front of the enemy, in front of acquirers, and get feedback. Ask them, what do you think of my business today? What would you change? And then iterate on that feedback over multiple quarters. And the final quote, the best quote of all time for M&A is, but I love your Warren Buffett quote, but my favorite quote is, the best businesses get bought, not sold.
That's interesting.
Right? It's a cool phrase, right?
That is cool. Yeah.
If you're doing the flirt, date, marry approach, what we like to do is encourage some of those buyers. We say, like, guys, if you want to take this great business off the market, make an offer. But if you don't make a good offer, the Fortia Group is going to run a really formal professional auction process, and you're going to have FOMO because you might miss out to one of your competitors. So that goes back to the word I said at the start, preparation. Preparation allows you to be thoughtful and smart and leverage deal tactics, M&A tactics, to your benefit.
Very nice. Now, this next question, let's talk about it from both perspectives, the perspective of both the buyer and the seller. And let's start with the seller. If somebody's interested, if somebody listening right now is interested in selling their business and they haven't done anything, what do their next couple steps look like? And then really the same question on the buyer. If someone has never bought a company, but is interested in doing so, what are some things that, what are steps 1, 2, and 3 for them?
So from a seller perspective, and I guess I would say this, but speak to some investment banks and consider hiring an advisor. Like, I don't know how to operate a brand. I'd never try, but I would engage someone to do it for me. I wouldn't know what to do. And I've done 25 years of investment banking. I've raised $20 billion worth of deals. I know how to do deals. So, but there's great independent research from the University of Alabama, which shows good advisors can get up to 25% higher valuation. So if you hire someone who knows what they're doing, they can hold your hand and guide you through. We have an 8-step process that we do, from early preparation, final preparation, marketing, negotiation, etc. So that's what I would do. I would hire a professional who's been there, done that. From a buyer perspective, there's various firms you can hire, including ourselves, to think about buy-side due diligence. There's some that'll do it for like one-off fee of $10,000 to sort of do a really detailed analysis of the target company. That can clearly help de-risk your view on the asset and have an independent view on the asset. But I would be very careful about, if you're going to buy a business, I would be very careful about not engaging an advisor who's done M&A for a living and a good lawyer. Otherwise, you might make mistakes that people have been making for the last few decades. You want to get rid of all those mistakes and make sure you're doing the best deal possible.
Absolutely. On the buyer side of things, one thing that seems to come up is raising capital. You have an entrepreneur that's a great operator and they want to make an acquisition, but capacity or just knowing where to get capital is the challenge. And so for those types of entrepreneurs, what would you recommend?
Yeah, look, the capital's hard to come by right now. Equity in e-commerce is really tough. Credit is tough. I would get creative and go back to that point I made, which is, try and think about a cashless merger. Find an entrepreneur who maybe can't sell or is, tired or wants to change the scenery, and say that, you will take on their business and give them a decent share of Newco. And then stronger together, you go to exit in 1-2 years' time as a bigger business, you're more likely to get a higher valuation multiple than going separately with two smaller businesses. So the valuation arbitrage is already a step forward. It's already a positive. So I get creative. Acquisition financing doesn't have to be the blocker.
Okay. That's really helpful. And we could probably do an entire podcast on creative finance in that. Anything else that we want to talk about valuation and exiting, and any other topics that you think would be particularly relevant?
Well, I think on valuation, let's get into the numbers in terms of what are the multiples. For FBA-led brands today, the valuations we are seeing are 2.5 times to 4.5 times SDE, seller discretionary earnings. And that multiple includes upfront and deferred. There's definitely deals pricing below that range, and there are some exceptions above the range we call diamonds, but by and large, that's the range we're seeing for growing typical businesses. That's FBA. DTC businesses trade at higher multiples because they own the customer. So the range is a little bit unhelpfully wide because we're seeing such a wide variety of businesses in all sorts of states, but it's at 3x to 12x EBITDA. And if you want to be at the higher end of that range, you need to have some of the things I mentioned: high revenue, great revenue growth, things like subscription. If all your revenue is subscription and you're in a category that's in demand like pet, you have a chance at getting a really high multiple today.
Okay. I'm curious, of say 100 Amazon sellers that you have interacted with recently, how many of them are successful on D2C websites?
Oh, that's a good question. I think ultimately, I'll put my acquirer hat on. The best businesses have to become omnichannel. So acquirers are looking for brands with a capital B, not a small b, right? They got to be brands, not products that compete with Chinese low margin rivals. And if I'm a serious acquirer and buy a brand, okay, it might start in Amazon, but I have to be able to be convinced that it could go full omnichannel, wholesale, retail, marketplaces, Shopify, etc. So we do like to see that the entrepreneurs are stepping into those other areas. And not everyone gets it right. It's tough, right? It's a different world. But if you look at Hero Cosmetics as a case study, one of the best case studies in the last 5 years. It started on Amazon, but then did what I talked about. It started to get into all those other channels to prove it's a real omnichannel brand, and then sold for hundreds of millions. So it's tough. It's tough on the entrepreneurs because you've got to try and understand all these different channels. But Amazon is crunching the numbers. The margins are getting tighter. You don't own the customer. So there's good reason to think about trying to engage DTC as well.
Yeah, hearing that answer, it makes me feel better. That's something that we've been challenged with is we're good at Amazon operators. We've been struggling on the website side of things. But no, I like your points on being omni-channel. And, ultimately that's what an acquirer would be looking for. So
bring it back to the point before though, David. So if you're a great FBA business in the pet subcategory, find your counterpart who's a great DTC business in the pet category, and let's come together. And then you've got a more, an omnichannel business, two co-CEOs maybe, or one chairman, one CEO, one president, and you're stronger. And you're gonna increase your valuation multiple by doing that sort of task.
I like that. I really like that. That's something that I think gets missed a lot when people are thinking about buying and selling businesses is collaboration and teamwork. And that example that you laid out is a great example of that. So anything else on multiples?
Well, just in terms of trends, right? So December 2021 was the high. They came down then for several quarters. They've been stable in our view for the last 2 to 3 quarters, and we don't see them changing this year. Interest rates is the key catalyst for volumes and valuations, and we have to wait to see interest rates come down before valuations will change. They'll never get back to December 2021, but there should be an uptick next year.
Okay. Very nice. And before we get to the fire round, for our listeners that are looking to exit their e-commerce brand, what type of clients does the Fortia Group serve?
We're typically looking to work with businesses that are worth between $10 million and $200 million. That's our sweet spot. It's called the lower middle market. So typically we'd like to see businesses doing at least high single-digit million revenue.
Got it. That sounds great. All right. Well, next up is the fire round. These are 4 questions that we ask every guest who is on our show. Are you ready?
Go for it. Yeah.
All right. What is your favorite book?
The first one that comes to mind is How to Win Friends and Influence People, one of the most famous business books. When I was joining investment banking, I remember that I think Goldman Sachs gave a free version of that book to all their graduate trainees. Really interesting book.
Absolutely. What are your hobbies?
Favorite hobby is skiing.
All right. We could talk about that. I like that too, but let's keep on firing. What is one thing that you do not miss about working for the man?
I worked for large companies like Morgan Stanley, amazing firms, but you're a number. You're working for maybe the men rather than the man, and you're a number. So co-founding my own boutique investment bank, clearly tiny compared to Morgan Stanley, it's great because you can drive the strategy, you get more client exposure, which I love. And when you do the deals and get them across the line, you get to, you're a part of that, genuine part of that, and you can celebrate it. That's a great way to celebrate deals getting done.
Absolutely. And last question, what do you think sets apart successful e-commerce entrepreneurs from those who give up, fail, or never get started?
Yeah, it's a great question. To me, I think the best e-commerce entrepreneurs are data ninjas.
I like that. I really like that answer.
I come from a Wall Street background, so I think quantitative, maths-driven quantitative approach to leveraging data science, AI, that's the future. And e-commerce.
Before you go, we wanted to share a new service that Ken and I have been using called Getita that has made us over $10,000 in Amazon reimbursements. The service requires no monthly subscription, and Getita collects a small percentage of the money they recover for you. It takes less than 5 minutes to set up and works on all Amazon marketplaces. Go to Getita.com, Getida.com, and enter promo code FTM400. That's FTM for Firing the Man 400 to get your first $400 in reimbursements commission free. How much money does Amazon owe you?